Hey, welcome back guys. This is Neil with Star Invest again. Today we're gonna talk about a lot of things that are red. But it was last Friday, red and red. You can see the light, they are all red. And even this one, Chinese Lunar New Year red pocket. But these are good luck. Reds are good luck. You want to buy when the markets everything is red, not when everything is green. Today we're going to talk about, since this is Sunday, the night before the market reopened after the crazy drop last Friday, after Trump response to Xi Jinping, president of China, that US may see 100% tariff for all goods coming from China. But that is a tactic. So far, we have been saying that two parties, before they come to the same table, I put chips here. I put 100%, 100%, right? So if we don't agree everything, then we can go down to from 100% to 90%. From 90%, I match you with 80%. Then I give you one more step. I yield to you one step, 60%. Okay, since you are nicer, I give you 50%, right? But if they start with zero chip, then the market is expecting everything will be good. Then if something, just something out of all the categories that they will be discussing, just maybe 20% of those every categories will not have total agreement between the two parties, then the market will react negatively, very negatively. But now, the last Friday, the event has already created the worst case scenario for us, for the whole US stock market. So they put all the chips on table. But are they going to use every single chips they put on the table? No. It will be 100% or less. Because when they both meet each other, they will shake hands, they will smile, they will yield to each other and have better understanding and agreement to find solutions that are mutually beneficial. It is not always, 100% is not always good to be just hope. I am very stiff. I'm not gonna listen to you no matter what. I will get the tariff. I will just initiate the 100% tariff. No, it's not like that. That is the negotiation tactic. Okay, let's go ahead and talk about what we are going to talk about today. First thing, margin usage for stock accounts have been trending up quite wildly. So, since the April stock market dip or big correction, we have been going up quite crazily. Some stocks, such as Lebius, NBIS, or CoreWeave, or some other AI stock, LLM model companies such as InnoData, INOD, ticker symbol, those companies have 4x, 5x. Those companies have returned a lot, 300%, 400%. When you look at AppLovin, it keeps on trending up, and Palantir as well, they both keep on trending up as if there is no tomorrow, until recently they start to correct. So for a stock market to have continued upward momentum, somehow after a good few months of uptrend, we need to have a pause, have a breather, and then so that for the fund which have already missed the first leg of the market uptrend, they can now have a good reason to enter the stock market at a better price. Then it will create a higher low for the next leg uptrend, right? Okay, first thing we will talk about margin usage for stock accounts, as we have just discussed. Second thing is month-to-month margin trend in 2025, which is basically also number one. So the next point will be Bitcoin price trend, as Bitcoin has been said to be the leading indicator for stock performance. So since 2022 or 2023, Bitcoin has been trending up, and a lot of people get confidence from seeing the crypto trend, their price trend, and then find reasons to buy into AI related company, blockchain related companies. So we will talk about that. And then the next thing will be Ethereum price trend as well, since Ethereum have been kind of not as strong as the upward momentum getters, but it's still lacking compared to Bitcoin price movement. And then we will talk about expected GDP growth rate for America, job market, which is very important, and the unemployment rate that are to be expected for this year and next year. Because these job market and unemployment rate are what, oh, my computer just closed, are what the Federal Reserve Bank look at to see if they should continue to lower interest rate or stop lowering interest rates. So we'll talk about that. We will talk about the upcoming earnings seasons for our American corporates, which is very important. Are we gonna expect the earnings to come down or continue to be strong? That will give reasons for new buyers to come into the market. And then we'll talk about consumer trends, which is very important. And then consumer saving and AI spending spree by American corporations. As American corporations continue to fight with each other to find AI supremacy so that they can gain a bigger market share in the future, they will continue to spend because they are expecting a higher return after their spending. Okay, we will talk about that, and then we will talk about the rare earth metal companies, because if China really does want to have high control of export of rare earth metals, then it is just logical that American corporations find new suppliers from our own country, right? So that would mostly benefit MP Material, ticker symbol MP. And then the other one would be the one that I have a holding on, which is USAR, is a ticker symbol. The company name is USA Rare Earth Metal Company. That is also another good one to have. And we will talk about AI fintech companies. What does the export control of rare earth metal have to do with fintech company? Let's say if the SoFi has to secure rare earth metal from China in order to give out more loans. Okay, we will talk about why it reacts so negatively, or did it just create a very good opportunity for new buyers to buy SoFi stock for the long term, right? Okay, and then the next we will talk about how all these rare earth metal company, AI fintech companies compare their business models against that of Amazon, Lululemon, Nike, where they sell their own company products that are imported from Asian countries, not just China, because as we all know, even the product that Nike made in Vietnam face a lot of higher tariffs also. So and then we will talk about how the market future is looking like as of now, tonight, 7:40 p.m. Before the market open tomorrow. So let's dive right in, everyone. All right, so as we look at how the market activities have been trending in 2025 as far as margin percentage for stock account usage, you can see that, let me get the cursor going, for stock account, right? Margin percentage for stock accounts increased substantially, with that hitting record highs over 1 trillion in the summer. That is major. Initial margin, a lot of stock account require 50%, but some actually requires as high as even 80%. I have seen maintenance margin and stuff, and then we can look at the trend, the monthly trend throughout 2025. January we saw 937 billion margin used. February drop a little, 918. March 880, April 850. That those would be the 3 months that the market started to drop, and April was the dip, the biggest dip, the lowest point. And then after that, from May, the market trend up, and you can see investors start to use more margins as the stock keep on going up. Many people use even more margin, including myself, because why not take advantage of the huge opportunities? There was a big correction which create a lot of opportunities for people who foresees that the upcoming interest rate decrease by Federal Reserve Bank will cause the stock market to trend up. People like me foresees that. So we did foresee that, so we took advantage of that and had some margin, so we have higher return, which I will talk about it in another video, because margin is another big topic. For those newcomers to the investment world, just don't use margins for now. It's very dangerous in bad times, even good times actually. Okay, so going back here, as we can see, August is already 1.06 trillion, which is the highest in the entire year, and September is even higher. All right, so with so much margin being used, it is just natural that we should have a good correction. So last Friday was a great correction, which came very fast, and then it could just go away just as fast, right? So look at the Bitcoin. The second point we look at is Bitcoin movement. See, the whole year has been quite good, from April going up, and the last 5 years, as we can see, Bitcoin price has been said to be the leading indicator for the stock market trend. So in 2023, it started going up, and then stock market actually start to go up towards the end of 2023 or early 2024. So even AppLovin, when I bought it, it was about here, November 2023. So yeah, that was the time, very great time to buy. As you can see, it is kind of like a straight line up. And every time Bitcoin become a little, take a little breather, it will trend up again. Take a little breather, it will trend up again. So it looks like it is a straight line going up actually. And with interest rate continue to be slashed lower, and US dollar to continue to be, to see weakness, I believe Bitcoin and Ethereum will continue to trend up. As you can see, Ethereum normally mirror the movement of the price movement of Bitcoin. So, but then these last 5 years, it has not been trending up as fast as Bitcoin has been since the dip of 2023. All right, so Ethereum may catch up faster soon. And then the next thing we look at is the multiple factors, including economic fundamentals, investor psychologies, technical trading analysis. All those can make or break a market uptrend. Okay, strong GDP. We do have strong GDP. Growing economic output indicates a healthy economy, which encourages investment and supports stock prices. How about job market? It has been quite okay, strong, not very robust per se, as AI disrupt more jobs categories. So and then we will talk about corporate earnings, which is widely believed to be quite good actually, especially for high-tech companies. Let's see. The GDP growth trend is a historic pattern of expansion and contraction, with a long-term average growth for the US of around 2.4% to 3.29% from 1930 to 2024. While the US economy grew steadily for decades, this growth is cyclical, experiencing some fluctuations with periods of robust growth. So the long-term growth from 1930 to 2024, average growth rate was 3.29%. And then recent contraction from Q4 2019 to Q2 2020, when we had that coronavirus shutdown. And recent expansion from Q2 2020 to Q1 2025. The economy was in an expansionary period, with GDP increasing at an average annual rate of 4.5%, which is very, very healthy. Full year 2023 was 2.89, 2024 was 2.8, and then 2025 3.8. So we are trending up actually, which is very good. With AI and automation, we should expect higher production. Hence GDP growth. And let's see, it is projected to be around 3% in 2025. See, 3% in 2025 compared to 2023 2.89, 24 2.8. So we are still trending up actually. See, so it is very healthy. Okay, so United States GDP growth 2024 grew by 2.8, 25 forecast to be 1.5 to 1.9. That is interesting. So this one that I'm reading is for global. It doesn't say actually. We will look into this a little deeper. However, if the Federal Reserve Bank see that GDP is not growing as fast as before, it just gives more reason for the Federal Reserve Bank to have more rate cuts in the future, which is actually a good thing for stocks. It is saying factor including higher tariff policy uncertainty, geopolitical tensions considered as potential risk, so they forecast it to be lower. All right. And then expected US unemployment rate 2025 is around 4.0 to 4.5%, and while 2026 projections are slightly higher, ranging from 4.2% to 4.6%. We just continue to give more reasons for the Federal Reserve Bank to continue to have rate cuts. So it is good for stock actually, because stocks is forward-looking. Stock prices are forward-looking. They don't really look at the current state of the economy. They look at the next 6 to 12 months mostly. So if Federal Reserve Bank lower interest rates, then for the second half of next year, the growth should be better. All right. So how about consumer spending? Consumer spending is expected to slow down, of course, if the mindset of consumers is that prices are gonna likely to be higher in the near future, then they probably want to save more. Then we forecast for nominal spending growth to be just around 3.7% in 2025 and 2.9%, trending down a little in 2026. A significant decrease from the 5.7% growth in 2024. So this may give some headwind to stock market. However, if the unemployment rate continue to be stable or as expected, and that the Federal Reserve Bank continue to provide market with rate cuts, then actually stock may see higher returns. So this talk about the economic and spending trends, slowing nominal spending, inflationary pressures, eroding purchasing power, rising unemployment, cautious holiday spending. So with cautious holiday spending, you don't want to hold stocks such as Amazon, right? Or Lululemon, Nike, but still a lot of funds still hold them regardless. because they are for long term. See, if you are a individual investor, if you have a long-term mindset, you should think like those big fund, right? They don't worry about short-term fluctuation. They keep on holding. They keep their holding. They keep their shares in Nike, in Lululemon, in all those companies which have products import from East Asian country with high tariffs. They still hold them. Okay, so consumer saving trends are expected to be improving because of the moderating economic growth, higher inflation, expected inflation, which may lead to a mix of cautious saving and strategy investment, which are good because we need to have better saving rates for US consumers actually compared to Asian countries. The US consumers actually have much lower saving rates. And then AI spending, the last couple of points we look at is AI spending by our American corporate. The spending spree should continue. Why? Because right now we are still at the very early stage of AI infrastructure build, and especially big tech companies of America, they want to have an upper hand in the competition, the AI arm race. So right now nobody has the upper hand in the race. So whoever spend more and get to the market faster, sooner, then they could have higher market share in the future. So in the short term, companies will still compete to spend more and more in the AI arm race, which will benefit data center stocks, energy stock, as AI data center needs a lot of energy, and then memory stocks, and some of the other cooling stock, cooling technology, because AI data center will create a lot of heat and those machines need to be cooled down efficiently. And then communication company for the data center to communicate with each other. So we will talk about those companies in the future in different videos. So right now, let's get back to AI spending. Gartner is a research company for finance. They estimate a jump from nearly 1.5 trillion in 2025 to over 2 trillion in 2026. Another research firm, Grandview Research, projects a more extensive timeline, with the global market expanding to 3.5 trillion by 2033. Spending is driven largely by massive investment in infrastructure and the integration of AI into products like smartphones and PCs. So with smartphones and PCs, they need to have cameras. They need to have the AI camera stacks. They need to have hearing and speech functionality, so AI speech and AI hearing stacks. So which company would be great for those two things? One is Ambarella, AMBA. That company, AMBR or AMBA, either one. Ambarella makes the cameras and AI functionality software. Oh, I can see myself, so nice. And let's see, and then the other one would be Somehow AI. Somehow AI is a AI company with SoundStack, AI stack. A lot of the especially fast food restaurant chains, they are using Somehow AI capability to automate their ordering, drive-through, and a lot of the data center or call center, they are using Somehow AI and to automate customer service, which is great. Somehow AI is said to be the leader in speech recognition with different accents from different group of people with different cultural backgrounds, and in the future they would expand into different languages. Then we also have Big Bear AI. They are also not profitable, by the way. All these companies are not profitable yet. Big Bear AI is doing the background infrastructure for facial recognition. So they expertise the people, the travelers passing through major airports. Due to all the long lines, they can expedite, the process. They recognize people's faces and let them pass very fast, and they recognize criminals, recognize people who are not supposed to be in any airlines. So as those AI automation mature in the future, those capability will be expand to other airports as well. Okay, let's get back to the last point, which is based on an October 2025 deal. OpenAI is committing to purchase a total of 6 gigawatts of advanced AI chips from AMD Advanced Micro Device through 2023. With a report value of up to 90 billion, which is crazy. And then OpenAI will receive a warrant to acquire up to 10% of AMD shares, which is crazy. See, OpenAI is spending 90 billions on the AI chips of AMD. See, they are still spending big. And OpenAI just commit to buy 100 billion worth. Let me take that back. Under the deal, OpenAI is committed to buy millions of chips from NVIDIA. And then NVIDIA will invest up to 100 billion into OpenAI. So, and then Meta is spending billions, almost hundreds of billions in the next few years to improve their and build up their AI infrastructure. And then Amazon is doing the same thing. Tesla is building their first hyperscaler data center as well. So the race is on. It's not ending anytime soon. So then would you expect the stock future to decline and continue to see red? Let's take a look. US stock futures rebound as Trump tempers tariff talk towards China. See? And as we can see here, S&P future is green, Dow Jones future is green, Nasdaq future is green, Russell 2000 future is green. So gold is green. Stop looking at VIX, just kidding. That is the fear index. Yeah, but the futures are green. So see, it provides a buying opportunity, as we have just talked about earlier. It has provided a buying opportunity for funds that has. Oops, I'm sorry. I have to change my hand. Am I looking good? Okay, still good. Okay, so for the funds which have not invested so far this year, they have missed out tremendously. So this minor correction, this quick correction, give reason for those funds to enter at a good or rather slightly bargain prices, for them, so they can hold their investment. They can start the investing, just like for example, if you have so far missed out for the entire quick uptrend of stocks for this year, would you be more inclined to buy once you see there's a slight correction, right? Rather than chasing high, now it provides you a better price, lower price to enter, and then join the uptrend. And as we have just discussed, the US Federal Bank will be having more rate cuts soon, and that will support more uptrend of current stock sentiments. And then so we probably should end here before I make the video for too long, and I'm kind of hungry, and before tomorrow I just want to calm everyone down. This is no big deal. We have seen the worst that the market could react to news when it was April earlier this year, right? So the market, a lot of participants in the market have seen the worst. And now this is the second time that we are going through it at a smaller scale. So why would we be scared, right? We have seen worse. We have seen worse. I mean, worse. We have seen worse reaction by the market. So this time is actually we should be prepared, because we should be looking for corrections after a big strong uptrend for several months. It has been non-stop. It has been non-stop for the uptrend, and people just kept buying, using more margin, and then these slight corrections just make people with huge margins usage to kind of cut some of their margins usage, right? So which become healthier for the stock market, and then new investors can buy stocks at cheaper prices, and then it provides more fuel for continued uptrend in the next few months. So I expect stocks to continue to have uptrend, and some high-tech companies may actually see 52 weeks highs for their prices, such as SoFi Technologies. What does SoFi Technologies has to do with rare earth metal export restriction or the tariffs? Do we use yuan from China, from Chinese money? Do we use yuans? Do we lend out money in yuans or in USD? See? And then all the AI company, what do they have to do with China? What do they have to do with tariffs? But if you own iLeafface, ELF, then of course, you know, they have their model products made in China and in Vietnam. Nike has their shoes made in China and Vietnam. So those are high tariff import locations. So then you may not want to invest so much in those companies, but not AI, not fintech companies, not rare earth metal companies. As a matter of fact, rare earth metal companies will be benefit. And as American government, our federal government wants to use blockchain and crypto technology as a superpower status for the rest of the world to see how good American fintechs is. They will just continue to adopt more fintech, especially in the area of blockchain and crypto. So it just benefit, you know, companies such as Robinhood, Circle, BMNR, SoFi Technologies, right? And then one more thing before we go. What about the looming Q3 corporate earning reports? Most of the fintech companies should see continued growth. All right, so see you in about few more hours. Okay, I will make another follow-up videos. Have a wonderful night. Thank you for watching again. Tomorrow will not be red, okay? I promise.